Are you worried about the future of investment banking, the space that investment banking will inhabit going forward as we see the industry move more towards commercial banking and essentially prop houses? Where will you fit in?
Well, as you know, we've adopted a client-focused, capital-efficient model for our investment banking business. And I think 2009 shows that that's been a powerful model and it's performed well. We are very focused on serving our clients' needs, using our capital in that pursuit, and have exited a lot of the proprietary trading and other big capital users on sort of non-client businesses. And so we feel like the performance in 2009 really underlines the power of that strategy, and we feel that that can continue to be a very sustainable strategy going forward.
And very briefly, you were just questioned on what you might do with extra cash. Can you rank your priorities, whether it's dividends, M&A, other type of investment? I know you're planning to invest in IT, but in terms of dividends and M&A, which ranks more up your list?
I think we do have a business model that's very capital generative, and we think that will continue to be the case. We clearly do have organic growth opportunities, and includes investments in things like IT and people, and expanding in the businesses that we already have. We do put a high priority on continuing to return capital to shareholders, so that's important. I think with regard to acquisitions, it's obviously very much depends on what opportunities are out there. I mean, we've been pretty conservative about acquisitions, and when you look at a space like private banking, for instance, when you've got a business that's generating 40 or 50 billion in net new assets organically during the course of a year, it's hard to find acquisitions that make a big impact on that. And so we're careful to make sure we can preserve our momentum and really execute on our strategy, but we'll still be opportunistic about looking at things. But I think we'll continue to subject those to a high bar.
Okay, so returning money to shareholders in the form of a dividend is still a priority for you this year?
I think that continues to be a priority, yeah.
Okay. Now, you didn't take any government money, but you still sort of reined in bonuses a bit to account for the UK tax. Has that affected morale with your US employees or even recruiting in the US?
Well, as you know, overall our compensation in 2009 is down a little over 20% versus 2007. Part of the impact of that was from some of the impacts of the taxes that were put into place in the UK. I think at the end of the day, I think that our employees overall are happy to be on a strong platform with a lot of momentum. I think they also understand the overall climate in terms of issues around compensation. So I think that they are comfortable that we have acted responsibly, and they understand the value of acting responsibly. So I'd like to think that our employees are actually very engaged and positive about it. And I think in general, one of the things that's been a big advantage for us is that we have introduced a lot of concepts on the compensation side which have really been industry leading in terms of I think a reasonable approach, responsible approach to compensation, and I think our people have actually been very supportive of that. So that's been it's been a big help.
So that's a no. Then there haven't been significant rumblings on this front from your employees ex-UK.
Yeah, I think people understand the context that we're operating in.
Okay. Do you expect to increase risk at all this year?
Well, in general, our strategy, as you know, is to continue to be very disciplined on the risk side, and I think that will continue to be the case. I mean, we clearly may well see opportunities. We could potentially expand the business in certain areas, so that might give rise to some increases in risk in different areas. But in general, our approach, in 2010, could do. But our approach is clearly to continue to have a capital-efficient model, which means that we shouldn't expect large increases in capital usage or risk.
Okay. I know what you said about January in terms of it being a really good start to the year, or more positive than the fourth quarter. But if the rest of this year turns out more like the fourth quarter of last year than a continuation of what you've seen in January, how much revenue is at risk?
Well, I actually think that's one of the positive things about fourth quarter performance was exactly that, which is we had a more difficult industry environment. And yet, even with that, if you exclude the one-offs in terms of some of the settlement, the large settlement that we paid out, et cetera, and the fair value losses, we made about a 15% return on equity. We continue to have a lot of momentum in our business. I think that's going to allow us to continue to take market share. I think there's upside in our private banking and our asset management businesses as well. So I think that even if we did have the fourth quarter repeated through 2010, I think there's probably upside to that 15% ROE, and our long-term target is 18% on the ROE side. So I think we actually are in a good position, and we're relatively optimistic about how the business can perform even in more challenging markets.
So you entertain the idea that the year could turn sour. It's not necessarily a continuation of what we've seen at the start of January.
Oh, I think there's always the possibility for that, and it's one of the ways that we think that we have configured our business in such a way that we can actually outperform in the more difficult, more challenging markets. And I think when people look at how markets have behaved the last couple of weeks, I think people look at it and I think people are reminded that we're not just going to have an uninterrupted benign move up in markets over time. So I think we clearly have to be ready for more challenging markets in 2010.
Can't operate on cruise control.
Absolutely.
Okay. Now, some analysts have been saying that your private bank could outperform UBS, be bigger than UBS by the end of the year. Is that a realistic expectation?
Well, I think we have been, very pleased with the consistency of the client inflows in our private bank over the last couple of years. I mean, if you look at over this crisis period, things have been very difficult, a lot of challenges both in general markets but also in terms of the cross-border environment, issues in the U.S., issues in France, the Italian scudo, which we saw in the fourth quarter, and yet we've seen very strong, very consistent inflows. And so our expectation is that hopefully that kind of consistent inflow will continue, and over time will continue to grow the business. So from our point of view, that's what we're focused on, is continue to serve our clients and hopefully continuing to see their confidence by bringing additional money to the bank. And obviously how that stacks up against competitors will depend also on what happens elsewhere. But I think from our point of view, we're confident in the continued growth of our business.
So I can see you're saying it's not necessarily a stated goal of yours, but it's a realistic expectation, yes?
Well, I think that it's realistic to expect our private bank to continue to grow, and our net new assets to continue to come in, hopefully on a pace, maybe an accelerating pace to what we've seen, and particularly as we start to see some wealth creation. Because if you think about it, the last couple of years, all the net new asset growth that we've seen has really been taking share, because there hasn't been 08 and 09, there hasn't been a lot of wealth creation from the beginning of 08 to 09. So once we start to see also some wealth creation, some net wealth creation, I think that will make it a lot easier and actually spur the net new asset growth.
That's your big theme for this year, the wealth creation.
Well,
that'll be the difference between this year and the past few years in terms of growth for you and for private banking.
I think it's possible. I think what the thing we like about our positioning is that even if we don't see that kind of growth, we will continue, we think, to take share and to be able to grow our net new assets. If we do see wealth creation on top of that, then that will actually just, we think, accelerate the impact.
What I'm asking is, do you see that this point right now as perhaps a point where it shifts towards growth rather than taking market share? I'm asking if you think the sort of client readiness is there.
Mm-hmm. Well, I think again it's very dependent upon what happens in markets. I mean, the client base has been relatively conservative over this period. I think stability and more benign markets is helpful to that. I think the last few weeks probably hasn't been as stable as people would like, so we'll just have to see how it develops. But I think there certainly is a good prospect to that, but we'll wait and see.
And on the growth, the further growth in the private banking unit, you added 50 people, client advisors, in the fourth quarter. Do you expect to add more in the first quarter after the bonuses have been paid out? Is that something you're aiming for?
Yeah, I mean, we certainly expect to continue to grow our advisors in our wealth management business.
In the first quarter?
Our expectation would be that we'd grow that in the first quarter. But again, we try to be relatively consistent around our intention to grow, but we're also opportunistic around if the market starts to heat up and people start paying crazy amounts of money to bring people on board, then we will typically back off a little bit. And in fact, we like to take advantage of markets where people are not hiring because they're concerned about the status of their business. Those are markets where we like to step in and hire some more. So, we look at it as more of a longer term trend, but we certainly are looking over time to grow, for sure.
Can you quantify the net new assets in the year to date? You said it's the strongest since the crisis began. How much have you seen come in January?
Well, it's really not. We're not actually releasing specific numbers around those net new asset flows, but what we've said is basically quarter to date. So January plus the first week and a half of February, we've seen net new asset flows from clients that exceed anything that we've seen since the crisis. So
Okay.
it's been a strong flow in of assets.
Okay. Do you still see any acquisition opportunities in private banking in Switzerland? There was a lot of talk about this from mid last year through to the end. It seems to have died down at the beginning of this year. Do you see opportunities within Switzerland to acquire in private banking?
Well, as you say, there have been some opportunities, and there have been some transactions that have actually been done. I suspect over time there may be additional opportunities there.
What time frame? This year?
I think there certainly could be in the course of this year, yes. And again, we'll probably apply a pretty high bar, though, to how those fit in operationally, and very importantly, that they're businesses that are highly compliant with regulatory structures, because that's very important to us that we maintain that.
On that point, does the idea that governments are willing to pay for stolen data, how does that change the way you do business? How does that change the business environment for you?
Well, I think from our point of view, we have for many years operated under the assumption that cross-border private banking business was going to be more highly regulated and more highly scrutinized over time, and that's why we have built our onshore businesses. That's why we have developed an industry-leading compliance framework around our cross-border business. So I think we will continue to push those efforts forward. Clearly, the issue of the privacy of our client data is something that's very important. We've invested a lot in IT and in solutions to make sure we can maintain the privacy of that data, and we will continue to do that. So, but I think in general, it's the environment has continued to move in the direction that we thought it would over the past couple of years as we've continued to build our business and drive it in the direction that we have.
What's it like having been a U.S. CEO in a Swiss private bank over the last couple of years? Has that in any way come up in your negotiations with regulators and discussions with regulators? Has it helped? Has it hindered? Has it impaired your ability to talk about the future of regulation on the Swiss banking industry?
Oh, I think obviously the businesses are all very global, and so and we've got a lot of obviously different people involved in the business around the world, and a lot of the players in the private banking industry globally and here in Switzerland are also of various different nationalities. So I think it's really it's a question of kind of content, and we've certainly been constructively involved in a lot of the discussions around the structure of the industry. But the most important thing is that we've obviously focused our business in areas that we think allow us to have a very resilient platform even against the different headwinds that we see in these areas.
So it hasn't been a significant asset or
I would
hurdle
say,
for you
no,
personally?
I would say it's neither necessarily a positive or a negative.
Okay. Are bankers overpaid?
Well, I think what we've tried to do, and we've obviously been very focused on trying to take a responsible approach to compensation, and we've actually been doing that for a number of years. I think what we've really tried to do is make sure that employees are rewarded only when shareholders actually get the kind of returns that they should get. And so if shareholders are not getting good returns, then employees should not be compensated. So I think it's all got to be judged relative to performance and relative to what value is actually delivered to shareholders. And so that's really our focus, is making sure that we've got very strong alignment between those two.
The changes in the way the industry's top management can be compensated are reforming the financial world as we know it. It's telling everybody out there reading the press that they are overpaid. Do you think that this message has been accepted by the top management? I know you said 60% of your top executives will have deferred compensation or deferred bonuses. Has the message come through that the world feels that bankers have been overpaid for too long?
Well, I think there's a clear understanding of the environment that we're in. I think there's a clear agreement that the structure of compensation needs to be long-term in nature. It needs to be subject to future performance. It needs to be, and it clearly needs to be such that, again, it's aligned with shareholders' returns and what's actually produced. So I think to that extent, that certainly is very well accepted. And then beyond that, it's obviously a question of what value can actually be generated for shareholders in the different businesses and franchises. But yeah, obviously, I think certainly I can speak for Credit Suisse. I think people clearly understand the environment that we're dealing in now.